$100,000 in unexpected taxable income. That's what one 58-year-old discovered when her insurance agent said the 1035 exchange was tax-free. It wasn't. Here's the one-line mistake that turns clean swaps into hidden gains. Most people believe a Section 1035 exchange, swapping one life insurance policy for another, is always tax-free as long as you move the cash value to a new carrier. That's the wrong belief. And by the time you file in April, it costs you $50,000 to $150,000 in ordinary income tax you didn't know was coming. This isn't theoretical. It happens every quarter to households earning $300,000 to $750,000 annually. Here's the correct reality. IRC Section 1035A defers tax only on the exchange itself, but the gain, the part that is taxable, equals your cash value minus your adjusted basis. Your adjusted basis is your cumulative net premiums paid over the life of the policy, per IRS Publication 939. If your cash value exceeds that basis, that gap is taxable ordinary income in the year you execute the exchange. Form 8949 is where the IRS expects to see it reported. Most agents never mention Form 8949 until your CPA discovers the omission in January. Let's run the math, because the numbers matter here. Imagine you've paid $200,000 in cumulative premiums into a universal life policy over 25 years. The cash value is now $300,000. That $100,000 difference, that's your taxable gain. At a 37% marginal federal tax rate, typical for a household earning $500,000 plus, you're paying roughly $37,000 in federal ordinary income tax alone. Add the 8% net investment income tax on the gain, and you're north of $40,000 in federal liability. But here's where it gets worse. If that extra income pushes your modified adjusted gross income over the Medicare IRMAA thresholds, $103,000 single, $206,000 married filing jointly in 2024, your Part B and Part D premiums spike by $560 to $840 per year, per person, for the next 2 to 3 years. A single $100,000 gain can cost $50,000 to $80,000 in combined federal tax and Medicare premium drag over a decade. And if you're still working, that extra $100,000 in taxable income might bump you into a higher bracket, triggering an additional $15,000 to $25,000 in state income tax, depending on where you live. Here's where the trap really springs. Most insurance agents, even well-intentioned ones, don't calculate or document this in writing. They tell you it's tax-free because the exchange itself defers tax under Section 1035A. They're not technically wrong about the deferral, but they're omitting the gain calculation entirely. By the time you sign, you've already committed to the exchange. And your CPA is the first person to spot the basis mismatch on Form 8949 in January. At that point, you're locked in. To calculate your real adjusted basis, pull your policy illustration and cumulative premium statement from your current insurer. Add up every net premium you've paid, not including policy loans or dividends you withdrew. That's your adjusted basis. Now compare it to the cash surrender value listed on your policy statement today. If cash value exceeds basis, the difference is taxable gain. Treasury Regulations Section 1035-1 locks this in the moment you execute the exchange. There's no do-over, no amendment on an amended return that fixes this cleanly. The one-line mistake most agents omit. They never mention basis in writing. They say tax-free and move on. Request a written basis calculation before you sign anything in writing with your agent's signature and E&O insurance backing it. If your agent can't or won't provide it, that's a red flag. A licensed tax professional should review the numbers independently. Your CPA, not the insurance agent's tax department. For households aged 55 to 65, executing policy consolidations, especially when interest rates drop and carriers refresh product lineups, this is critical. You're in a pre-retirement year when tax bracket management is tight. A surprise $100,000 gain can destabilize your entire tax plan, push you into higher Social Security taxation, 85% of benefits taxable above $25,000 single income, and lock in higher Medicare premiums for years. If you're considering a 1035 exchange, pull your basis calculation today. If the cash value exceeds cumulative premiums paid, talk to your tax professional about whether the exchange still makes sense, or if there's a better year to do it. The tax code rewards those who study it.